Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust everyone had a great weekend. Equity markets, equity futures particularly, opening the day a little bit cautiously in the Asian session. And I think there's good grounds for that. Basically, the market just kept extending last week on any piece of economic data, regardless of whether the economic data made sense for a rally or not. One of the interesting things, which I haven't really brought to people's attention before, is while the market has been celebrating, sort of the demise of the US economy, very bad data events or outcomes for the growth of the US economy, and a little bit that fourth quarter GDP wasn't as bad as many thought it might be. But overall, the data is maybe not as bad as it needs to be. So people have been celebrating because they think, well, if the economy is in dire straits, obviously the Federal Reserve will stop raising interest rates and it'll even pivot. And remember how I laughed at that from the very first moment I heard that word? And certainly laughing at that view has been the way to go. I noticed that a organisation in Australia today has got some press saying that the RBA will be cutting interest rates this year. It's such an old, outdated idea from 12 months ago, which didn't come to fruition in the US and isn't going to come to fruition in Australia either. Yes, Australia is going to have a recession. We were the first to call it, forecast it. And yes, it's going to happen. But the RBA will not be cutting interest rates because inflation will remain quite high. Coming back to the economic data getting worse. But in the US last week, the employment data was very strong. So the economic data, you could celebrate it in a twisted, kind of convoluted way to say that'll mean the Fed will stop raising rates, but it doesn't matter where rates are if your company can't make money because the US economy is in a recession. So the idea of buying stocks on that whole scenario is a little bit questionable. But from that mistaken point of view, I'd suggest to you that really what's going on is in any case, the economic data in the US is not bad enough for the Federal Reserve to be concerned. In fact, the Fed chairman has said repeatedly, as I've said on these podcasts repeatedly, that he is quite happy and he understands that the US economy will experience pain. And what he wants to do is slow the US economy, and he really wants to puncture the employment outlook. And that's something that current interest rate hikes simply have failed to do. On top of all of that, on Friday, we saw the PCE core inflator index actually rise in the most recent month. It accelerated from 0.2% the previous month to 0.3%. And the Fed's very much aware that across the services sector, and particularly in the area of shelter, there are a lot of pipeline pressures yet to come through and bear their weight on that CPI data. So there's still pipeline pressures for higher inflation. And now we're seeing oil prices, well, until Friday just moved to the bottom of the 2-week range really. But overall oil prices are about 10% off their lows of last year, of recent months. And that means, and we're already starting to see it, gasoline prices are starting to stabilize in the US at the petrol bowser, at the pump, and they could well be rising again soon. So this is not an environment for the Fed to go, oh, you know what? We'll just hope that inflation keeps trending down and forget about all this other stuff, and we'll just hope that employment miraculously starts to soften. So no, the Fed's not going to act on hope. The Fed's going to act on the idea that for the moment, there still seem to be persistent price pressures, and we have to be careful not to take our foot off the brake too early, and therefore they're probably going to hike by 50 points. Now, I think we'd probably be about the only people in the world forecasting a 50-point rate hike by the Fed at this stage. But I can really see a very strong argument for why they would continue to do that. And as I've said repeatedly, it's far better for the Fed to do another 2 or 3 50-point rate hikes than to sort of drop down to 25 points and then spend a whole nother 12 to 18 months doing 25-point rate hikes for at least 6 to 12 months. Better to get it over in 2 or 3 meetings, and then they can go on pause. I'd say they're going to go on pause now after 1 more 50-point or 2 more 50 points. 2 more 50 points, then a pause, or a 50 points, then maybe 2 25 points, then a pause. That's the Fed trajectory. There is no reduction in rates on the horizon at all. And that's why the US economy is going to continue to spiral to the downside. As we know, the services sector, 70% of the US economy, is already in contraction, according to the official ISM survey. Manufacturing is in trouble. Retail sales are in trouble. This is an economy that is in a downward spiral. And by the way, when I'm saying what I think the Fed will do, it's not necessarily what I think is the right thing for the Fed to do. It's what I think the Fed will do. I think they will hike still again at 50 points, but with a lot of rhetoric around that may well be at the last 50-point hike. So you could even see markets go, okay, so it wasn't our 25 points, it was 50 points, but that's probably the last one. So yay, let's buy again. But that whole idea is starting to really run low on fuel, if you like, partly because everyone who believes in that nonsense has already bought. We've seen spectacular rallies in stocks so far this year. But also because it's ignoring the underlying very harsh reality that things are going to be very tough for American consumers and businesses over the coming year. And therefore, corporate earnings are going to be well down. And that's even taking into account that boards of directors have already lowballed their outlook on earnings. So expect disappointment all round on the equity front this year. But for the moment, people just seem to want to ignore that and say the only thing that matters to a stock's price is what the Fed's doing. That's not the case at all. It's never been the case historically. There are moments where there seem to be correlations, but often both things are reacting to the same stimuli. But it's far more complex than that. And I'd suggest to you that these rate hikes by the Fed are going to drive. And remember, the US economy was ready to slow anyway. I made forecasts for recession before there was a war in Ukraine for the US economy. So the US economy was ready to slow anyway. Then you've got a war, and then you've got hyperinflation, and then you've got a late to the party, and I said in real time they should be raising interest rates slowly 18 months ago, but they didn't, okay, to avoid doing exactly what they're doing now. So all of that forecast that they would get it wrong and be doing exactly this is proven completely correct. And now I think they will continue to finish the job of being overly aggressive before they begin to pull back to start to sort of take a more reasonable middle road, if you like. So that 50-point rate hike would be a real shock to the market, but the market still has the ability to spin absolutely anything these days into a positive, but I think we'd be getting towards the end of that positive elastic band stretch to the upside that we've seen so far this year. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.